while the stock market was rallying, and gold pulled back. Gold had about a 10% pullback. Gold almost got above 3,500, and this morning it was well below 3,200. In fact, at one point overnight, gold was down about 20 or 30 bucks, and that was following about a $70 decline yesterday in gold. In fact, I was watching gold in the morning, and it was down about $15 or $20. And then over about a 2 or 3 minute period, it got clobbered by like another 50 bucks. No news. Nothing happened. Somebody just decided to dump, a shitload of gold, at 6 a.m., 6:30, whatever the time was. And the price just got killed. And it pretty much stayed down all day. And then it went down a little bit more last night before it had a big reversal. Gold was up about $60 today, so about $80, $90 off of its low. And so I think today marked the bottom of the gold pullback. So I think it's over. And, gold's now, 3,200 and change. Let me see where it is now, 32.35. And I think the bottom is in. Now, it's possible we can go a little bit lower, but I don't think so. I think 3,000 is the new 2,000. If you remember when gold was above 2,000 initially, and I said 2,000 is the floor, you got to buy it. Well, now 3,000 is the floor. You got to buy it. It's, we're not that far above the floor at 3,200. You're not that far above 3,000. If we make another 50% move, which I think we could easily do, which is what we did from 2 to 3,000, that takes from 3,000 to 4,500. Well, we're a hell of a lot closer to 3,000 than 4,500. So you should buy it. But of course, the best thing I think to buy of the metals is silver, because silver is still around $32 an ounce, $32.70. When gold was at 2,000, silver was about 30. And I remember when silver first got above 30, I said, okay, 30 to silver is 2,000 to gold. And I was right in that silver didn't go back below 30, just like gold didn't go back below 2,000. But then gold went way up and silver didn't. You had a 50% rise in the price of gold, but barely a 10% rise in the price of silver. So if you missed out on $2,000 gold, just buy silver, because as far as silver is concerned, gold is still 2,000. Anyway, you can buy both metals at Schiff Gold. So just go there and fill up your cart or talk to one of my reps. It's not called Schiff Silver, but maybe I'll have to rename it one day, because I am very bullish on silver. I'm bullish on both, but it's because I'm so bullish on gold that I'm even more bullish on silver, because I know eventually if gold keeps going up, silver is going to catch up, not to the price, but it's going to catch up percentage-wise and close that gap. It's not going to be 100 to 1. At a minimum, my target is 50 to 1. And so at 50 to 1, that means the price of silver doubles relative to the price of gold. But that's not just going to be a double, because the price of gold is going to keep going up. So silver is going to double relative to a gold price that's much higher than the current. There was a discussion of a selective default on foreign holders of our treasuries rather than domestic holders, who obviously, could vote and would not be too happy about, not getting their money back. But the Chinese can't vote in our elections. And so I think that this trend is now accelerating to get out of the dollar, and not just the dollar, but dollar denominated assets. So bonds, stocks, and in fact, the stock market has recovered, all of its losses, but not the bond market. On Liberation Day, the yield on a 10-year treasury was under 4%. Today, it's almost 4.5%. In fact, yesterday, it closed at 4.54. We had a bit of a rally today in the treasury market, and so the yields are back below 4.5%, but they're not that far below. We're at 4.44 on a 10-year. So hardly any of the loss has been recovered. Same thing for the 30-year. 30-year was below 4.5, and now it's almost 5. It closed at 4.9. It was, I think, 4.97 yesterday. And so the relief rally in the stock market did not spill over into the bond market. And that is a huge vulnerability, not just for the U.S. economy, but for the stock market rally. Because if the bond market really rolls over, if we break decisively above 4.5 in the yield on the 10-year, which is breaking down. Remember, that's when Trump initially paused the first round of tariffs, not the Chinese pause, but the initial pause. It was because he said the bond market was getting a bit yippy. Well, it's yippy yappy, right? It's still, doing what it was doing. It's just not as quick. It was a sharp collapse back then, but now it's back at the same level, and I think it's getting ready for another sharp collapse. So the tax breaks are going to end up costing more than the government thinks, and so the increase in the deficit, and they already acknowledge this bill is a deficit buster, right? The cuts in spending pale in comparison to the cuts in taxes. And again, they don't even kick in, right? The big Medicaid cuts, again, they kick in 2029, so they don't even count. They're not going to count in 2026. They're not going to count in 2027, and they probably won't count in 2029 because in 2028, they'll get rid of it, right? Because, oh my God, we have to stop these cuts from coming into place. We have to act now, or there's going to be cuts to Medicaid, which, so that's what's going to happen. And so the deficit is going to go up. And so I was right about this from the beginning. All this talk about Doge coming in there, cutting $1 trillion, $2 trillion, none of that's going to happen. The debt is exploding. The deficits are exploding. The big, beautiful bill that Congress will pass and that Trump will sign is going to have bigger deficits and more government spending than what we had under Biden. Now, that doesn't mean that we wouldn't have had even bigger deficits and more spending under Harris. We would have. But what it means is that nothing has changed, that we're on the same trajectory. We're still headed over a fiscal cliff. We're going to have a U.S. dollar crisis. We're going to have a sovereign debt crisis. And that has been amplified by what we've witnessed over the last month or so with the reaction to the tariffs post-Liberation Day. So this is, I think, what the world is now going to pay attention to. The distraction of the trade war is over, but now we're focusing on the budget deficits rather than the trade deficits. Both of them are exploding. The dollar's days as the reserve currency are numbered. And so that means you have a finite amount of time to diversify yourself. Yes, the world is getting rid of the dollar, getting rid of U.S. assets. Americans need to do the same thing. We need to make the same trade.